Hey everybody, welcome to the morning market briefing, June 7th, 2022. It is a Tuesday. Hope everybody's doing well out there. Getting our bearings a little bit right now. Dow futures down about 70 basis points. S&P futures down about 84. Where do we want to jump in? I mean, my leaning is I feel like we should talk about Target.
Yeah, we got to start with Target.
We got to start with Target. I wish we didn't have to talk about Target. We got to talk about Target. Tough times, down about 10% pre-market. This shortly after getting hammered on earnings. They have already come back out and made some adjustments to guidance. Ben, what are we looking at? And obviously for the company, it's a pretty decent hit that we're taking here. But how would you kind of read through maybe the global view on the actual economy and what's going on with consumers?
Yeah, I saw someone on CNBC earlier this morning saying that the consumer is healthy, and I said, "Have you looked at the Target numbers?" So basically, what they did is Target took down its margin guidance for the second quarter from 5.3% to just 2.0%. They took down the back half of the year from 6.7% to 6%. So it's basically about another 20% guidance reduction for the full year and about a 75% reduction for the second quarter in terms of earnings. So a big hit for Target. That's all on the margin side. Revenue is actually reiterated. So what they're seeing is people are buying at higher prices your essentials, your toilet paper, your paper towels, your food, your drinks, and your beauty, which also encompasses kind of your shampoo, all that sort of stuff. What they're not doing is they're not buying the home goods. They're not buying the mirrors. They're not buying the dinnerware sets. They're not buying the candles. And so what they're doing, they're not buying the patio furniture. They're not buying the small appliances. So Target is having to mark that stuff down very aggressively just to clear out that inventory. Meanwhile, they're actually increasing prices on those essential categories like your shampoos, like your paper towels, like your food. And that's actually allowing them to reiterate their revenue guidance, but it is coming at the expense of the margin guidance because a lot of those places where they are seeing markdowns are those areas where they have more of the margin. They say they're trying to remove excess inventory. They're canceling orders. So canceled orders come with cancellation costs. They're trying to add incremental holding capacity near U.S. ports. That's going to come with incremental costs. They're working with suppliers to shorten distances and lead times, but they are raising prices to offset high transportation and fuel costs on those essential categories. They say rapid revisions to sales forecasts, promotional plans, and cost expectations. And they say that in those discretionary categories, trends have, quote, changed rapidly since the beginning of the year. We're seeing just massive disruption in the consumer space. Clearly, the consumer is extremely squeezed right now. They're seeing their savings accounts go down and down. Credit card debt outstanding is going up. Credit card delinquency so far okay, but consumer is definitely getting squeezed.
Yeah, it's interesting with Target. I mean, I think a lot of our narrative, at least internally, has been that it felt like the last quarter was kind of a throwaway quarter where they said, hey, this is going to be bad. Let's take it on the chin. Let's rebuild. Ben and Tom, I guess. Tom, former employee of Target, no big deal, inside source. Curious your thoughts. I mean, how much of this do you think is that the consumer narrative has truly changed that much that quickly versus mismanagement in terms of not really understanding the trend of what was going on? Do you guys have thoughts there? Because, I mean, if the narrative was we're throwing away the last quarter, we shouldn't be seeing this revision if nothing's changed.
I mean, I think it's a little bit both. I think what led to Target performing so well during COVID was that people were buying all the stuff that they loaded up on inventory, TVs, extra things, the high margin, low utility products. I mean, we're flying off the shelves. And now, we've seen the narrative change. I think the consumer has changed. I think we all can agree that how we're thinking about spending money has changed quite a bit since inflation has really taken off. And I think that they got caught offsides. I think that management wasn't seeing the writing on the wall, didn't see this coming really at all. And so I think it's both. I think the consumer has changed, but I think management was not agile enough to change that. And even after blowing the first quarter, here we are in the second quarter. They're like, man, we are so far behind the 8-ball that we're going to have to go ahead and let everyone know that we're going to trip here.
They provided guidance 3 weeks ago.
Yeah.
And they just cut guidance by 75%.
That's what
that's a crazy situation. And I think we have to also go back and understand who this management team is. This management team has done very well in the past.
Yeah.
And so that's who they are, I think. And people are saying, well, Walmart's not going to downgrade. I think Walmart's going to take their guidance down. I think Amazon's probably going to take their guidance down on the consumer business. And I think that the market is pricing some of that into us to an extent. This is surprising in how quickly it's coming in and the severity of it. But I do think that this management team is skilled. And I think that they're trying to make these moves early because I think that Jamie Dimon was right. At the end of the day, I think Jamie Dimon has his finger on the pulse of the American consumer, and he says a hurricane is coming. And he doesn't know what size it's going to be. And it may be kind of, one of those hurricanes that taper out. But it's something to be mindful of. And you can still invest in the interim and be smart about it. But like we keep saying, be smart about the purchases, be smart about investing, and make sure you're buying businesses that are there for the long term.
I think there's something to be said too about being the first mover on lowering expectations, just coming out and say, hey, listen, this is getting rough. We're letting you know right now that it's not going to be what we thought it was, and just set that expectation early, be honest about it. As opposed to just surprising everybody in 6 months. I think you're going to get punished a lot more than you are today. If in 6 months you say, hey man, we weren't even close. Our guidance was completely way off and we didn't indicate that in any way.
It's the good operators that have been guiding down. It's Microsoft, it's Target, it's Salesforce. Those are the companies that have guided down so far.
And I think the other side, kind of to Tom's point about being the first mover, you're going to get punished if anybody in your peer group does the same thing. So you might as well go first in some regards. Look at Walmart's down 3%, probably on this news for the most part. I'd imagine a number of retailers are struggling. Amazon down 95% yesterday because of the stock split. But Amazon yesterday was up 2%, it's down 2.5% today. All these companies significantly lower than where futures are pricing right now for the major indexes. So kind of interesting there. Boris Johnson did survive the confidence vote. How long is he going to be safe there?
I don't think he's going to be, he could stay a little bit longer. It's the smallest survival vote margin from a confidence vote since Margaret Thatcher. He had 41.2% of conservatives
nailed it
vote against Boris Johnson. That's more than 36.9% who voted against Theresa May. Theresa May only lasted another 6 months. So in theory, Boris is safe from a confidence vote for a year. The rules could be changed, but I would anticipate he's probably in there until the next elections just because he's a different personality. But you're seeing the political ramifications of the inflation and the economic squeeze.
Margaret Thatcher.
I'm not sure who you're doing an impression of. But...
Of Margaret Thatcher. She had a weird voice, right? Or did I make that up? Yeah,
but she's British. I think the read is a little slightly different. I'm not going to comment on what my read is.
Somebody pull a sample of her voice. Look it up, people. Japanese yen breaking down further. Tom, you want to do a voiceover for this one?
Yes.
There's no winning here. Japanese yen breaking down further, Ben. Just kind of this story just kind of continues.
Yeah, this was the widowmaker for a long time because a lot of people tried to short it and it just kept getting stronger and stronger. And then in 2012, it kind of changed. It was in the 80s, and I just remember it started to go, and it hit 100 and then 105. Well, today it's just hit a new high level, which is 132 yen to the dollar, which means it's a weak currency. It's breaking out. It's basically been devalued by half over the last decade, and that's their MO. They want to continue to value the yen because that's really the only arrow they have in the quiver. I think that ultimately continues, but I wouldn't be surprised to see some a little bit of stabilization here in the relatively near term.
On the oil front, Goldman's expecting oil to be at $135 per barrel for the second half and first half of 23, second half of 22, first half of 23. Kind of interesting because at a high level, it seems like there's been some things that would potentially alleviate the pressure on the pricing for oil, but we're just not seeing that come to fruition because there's still just such an undersupply. As we're looking at oil in these plays, it seems like what's interesting here to me is that we're really moving away from the Russia-Ukraine story and more into this is potentially going to be the normal for a while.
Man, this was a massive report. The guy did a ton of research. It's I don't know how many pages, but there were 32 different pieces of analysis that he had in it, 32 different charts that he had in there, along with a ton of commentary. So I skimmed it this morning. I didn't read the whole thing in its entirety, but he was talking about Brent oil to peak at $140. It's currently at $119. It's going to remain elevated. And his big point is, look at everything that we've had over the last 2 months that should have been negative for oil. We've had China COVID lockdowns, massive decline in demand there. We've had record large sales out of the Strategic Petroleum Reserve. That's actually going to go away. China's opening up again. And we've had modest declines in Russian exports, which might continue. And so that structural deficit remains unresolved. OPEC isn't really getting aggressive. Investing in logistic issues in the U.S. means that shale oil isn't coming back very strongly. So there's a lack of supply response right now, which is just going to keep oil prices quite high. And so his view is that we're going to have $135 per barrel oil for the next year, which is, again, 10% higher than we have right now. And he said, importantly, that because of the refining aspect of it, it's going to act like $160 barrel per oil, which means your gas prices are going up. Gas prices now just hit a new high, all-time high, $4.92 a gallon.
Congrats.
Georgia remains better than that at $4.33, according to AAA. And I think California is like $6.37 on average. So really rough for them out there.
Very rough. Tom, we do have Janet Yellen, who's been in the news quite a bit for all the wrong reasons, appearing before the Senate Finance Committee today, as well as the House Ways and Means Committee tomorrow. These committees are always kind of weird. I mean, you'd like to think there'd be something substantive that comes from them. It tends to mostly just be political posturing for ads. But she's going to be talking through the administration's budget request. Inflation is undoubtedly going to come up. What are we looking for? And just kind of what's her job security looking like right now?
I think she's on the hot seat, to be honest. I think she's sort of stepped out on her own in terms of what the party line is. The main concern I think that people are focusing on is that, I guess in her new biography that's coming out, she had concern about the American Rescue Plan and how that would affect prices. And you're basically saying, if we put $2 trillion into the economy, it's going to create inflation. Which also goes against her saying that she thought that maybe it wasn't going to last week, or she had a bad read or didn't understand what was going to happen. And part of me wonders if she was told to say that, because I think that, listen, she's one of the most well-educated people we have in this country in terms of pure academic economic output. So she knew what was going to happen. And so I think that's what's going to happen. I think she's basically going to have to get up there and say, no, the $2 trillion we pumped into the economy was awesome. It saved us from the pandemic. It's definitely not causing inflation. It's supply chain issues, and definitely not the fact that we printed an unbelievable amount of money over the last couple of years and then just fed it out to people to buy sneakers. So I think that she's probably going to get grilled today. I think that we're sort of moving into this sacrificial lamb piece of economic drama, I guess you could say. Jay Powell, I think, is being set up to be the sacrificial lamb by the administration. I think Janet Yellen as well. They can basically say these are the two that were responsible for it. He printed the money, she spent it, and now these are the two that caused all the problems, and it definitely wasn't us. It's sort of how it seems to be shaping up in the way it looks. We saw that even with the op-ed that was put out by the Biden administration saying that, it's the Fed's responsibility to fix this. When in reality, a lot of policies that were put in through by the government at large have caused a lot of problems. And so it should be interesting. She's always an interesting character. She's known to be exceptionally boring. So I imagine there's going to be a lot of that, though she also has had some very wild press conferences in the past where There's one where they thought she had a stroke, where she just like freaked out, had to stop and walk away from the press conference. So there could be some interesting fireworks. So I wouldn't say I'm excited to watch it, but I will, and we'll see. I have Janet Yellen. I'm not going to do the impression, but she sounds like a cartoon duck. If you've ever heard her listened to her talk, and she also has a very unusual mid-Atlantic accent. She says the word "measure," so she's always measuring the economy. So I think that's a big takeaway as well. If we're going to be doing impressions,
does she say "water"?
She does. I don't know. That doesn't come up a lot.
Yeah. Oh, well,
but you know,
different liquidity, I guess.
Unless there's going to be some inflation with water coming up.
Apple rolling out a new iOS 16 coming out in September. Number of new features here. Apple Pay later. You're going to be able to delete previously sent text messages. People are very excited about that. There's nothing good that will come from that, I'm sure. They're re-engineering the News app and putting a bigger emphasis on sports, which is pretty interesting to me, as they're also trying to get into the running to acquire NFL Sunday ticket contract, which would be very big for Apple TV, all that stuff. Unveiled a new MacBook and an M2 chip inside of it coming out next month. Probably a good time for Apple to be doing some stuff. I mean, just given where the market is, given projections for phone sales, this was probably scheduled anyway. The Worldwide Developer Conference, they gave the keynote, but it's good timing, I think.
Yeah, I think it's good timing. It just goes to show, they're even in the midst of these economic machinations that we talk about, companies are still there are good companies doing innovative things. And will Apple get rewarded for that in the near term? I don't know. But I think they're setting the stage to be an even stronger company with stronger market share coming out of this, with real loyalty and an entrenched user base. And I think that's good. And they're focused on what they can control. And whether that means they have to cut their iPhone production schedule, which we already talked about a few weeks ago, for 2022. I mean, it means that. But they're also setting the stage to really emerge from this in a very strong position. And I think they will.
Cool. We'll wrap it up there. We'll be back tomorrow morning at 8:30. Talk to you guys soon.